Why we use GDP and GNP to measure the national income? It is because it provides a comprehensive and standard metric to assess the economic performance and overall wealth of a country. GDP are typically used to see the overall economic activities within a country and to compare the economic performance across the different country. For GNP, GNP are useful for understanding the total economic strength and the income level of a country resident, including the international economic activities. Both GDP and GNP are important tools in macroeconomic analysis. They help in understanding the economic dynamic of a country, guiding policy decision, and facilitating international comparison. GDP are measuring by three types of approach, which is expenditure approach, income approach, and value-added approach. For the part of perspective, expenditure approach are focused on the demand side and capturing the total spending on the final goods and service. In income approach, are focused in supply side and capturing the total income earned by the factor of the production. Value-added approach are focused on production process and capturing the value added at each stage of the production. For the component, the expenditure approach component are included consumption, investment, government spending, and net export. Income approach component are included wages, rent, interest, profit, and statically adjustment. Value-added approach are calculated by the subtracting intermediate consumption from the total output. For the usage of the expenditure approach are common used to analyze the consumer behavior, investment trend, and government policy impact. Income approach are useful for understanding income distribution and the contribution of labor and the capital. Value added are helpful in analysis industry specific contributions and avoiding the double counting. By using these three methods together, the economists can gain a comprehensive understanding of a country economy's performance. So, next I would like to pass to my team member to explain more about the expenditure approach, income approach, and value added approach.
Expenditure approach is a method of calculating gross domestic production (GDP) by summing the amount spent on final goods and services produced within an economy during a particular period, usually a year. GDP is a measure of the economy by measuring the size of the economy through production. It is calculated the same as aggregate within the economy. It illustrated the positive relationship between aggregate demand and GDP. Expenditure of growth is the total value of goods and services. GDP is calculated by editing the expenditure on them across the four different economic sectors. First, I will explain about real GDP. Real GDP is equal to expenditure of growth when Y equal to AE. Y is expenditure approved by economy and AE is aggregate expenditure. The fourth component is consumption, investment, government, export minus import. Now I will explain about aggregate expenditure approved. First is consumption. Consumption is anything household buy from domestic producer, not importing goods. This includes grocery, furniture, and private spending generally. Second, in investment. Investment is expenditure on new capital. For example, a factory used to produce cars. Next is government. Government will be spending like public road, school, and hospital. And the last one is export minus import. Export are goods and services through from foreign country, and import are goods and services bought from foreign country. For equilibrium of economy is GDP equal to AE. So consumption plus investment plus government plus export minus the import. This is picture for circular flow model of economic illustration. Why we need to use the circular flow? This is because this circular flow is used to mention a national income. As the circular flow model mentioned book cash coming into and exciting a national economy. It is also used to guard the interconnectivity between sectors. As a fully robust and strong economy, we have interaction between components. For instead, the relationship between a government citation policy and a household consumption spending will have a direct impact on a business ability to sell goods. So, we use the circular flow model of an economy illustrating to prove that equilibrium when good market equal to input market. What is a growth market and input market? Growth market is used in standard economic theory. This is referred to online platform promoting ethical or sustainable product, focusing on social good alongside economy, action, and for import market is well-defined concept in economy. This business acquires the resources needed to produce goods and services and are called factor of production. They have their main type. The first one is land, or natural resources used in production such as mineral. Next is labor. It's the human effort used in production such as worker skill and experience. And the last one is capital. It's physical good and financial resources such as building. Now let's see the difference between good market and input market. For focus, good market emphasize social good, meanwhile input market focus on resources acquisition for production. For participate, good market may involve consumer seeking ethical product, and for import market will involve business buying of production. For impact, good market may influence consumer behavior, and for input market will directly affect production cost and output price. What is the connection between good market and import market? The price in import market can influence the goodness of product in a market. For example, if sustainable resources are expensive in the import market, it might increase the cost of good product made with those resources. From good market, they will get income, and the income they will use back to spending on good market. This is how to calculate GDP using expenditure approach. First, you need to find consumption, investment, government, export, and import. If you already find of this component, you can calculate the expenditure. What you need to do is consumption plus investment plus government plus export minus import. So 4,000 plus 1,000 plus 2,000 plus 600 minus 900 equal to 6,700. Why expenditure approach does include net depreciation? This is because expenditure approach focuses on new goods and services produced, and depreciation reflects the decline in value of existing asset, now new production. Including depreciation in expenditure approach would be like double counting, as the initial purchase of the asset was already included when it was first bought, while GDP measures the value of what is produced in the country. Net national income measures how much of that value stays in the country.
Assalamualaikum and a very good morning to everyone. So for my part, I will be presenting the income approach to calculating the GDP. Basically, income approach is another method of calculating the GDP. It will produce the same dollar amount of GDP with the expenditure approach. It is based on the principle that all expenditures in an economy should be equals the total income generated by the production of goods and services. So, the income approach of computing the GDP consists of two main steps, which is the first one is compute the national income, and also the second one is adjusting national income for certain things. And the final result will be getting the GDP. We go to the next slide. So for the next one is benefit of using income approach. The first one is distribution of economic prosperity. It provides a perspective on the distribution of economic prosperity, showing how much income is derived from various sources within the economy. The second one is health of different sectors. By focusing on incomes, it helps assess the health of different sectors, such as how much business are profiting or the extent to which labor is being compensated. The third one is insights into income distribution. It provides insights into the distribution of income across different sectors of the economy, and also helps gauge the overall economic performance of a country. And the last one is complement to expenditure approach. The income approach complements the expenditure approach to calculating the GDP, which adds up consumer spending, investment, government expenditure, and also net exports. Bear in mind that this benefit make the income approach a valuable tool for economists and policymakers. However, like all economic measure, it has its own limitation and should be used in conjunction with other indicators for a more comprehensive understanding of economic performance. Okay, we go to the next one. So for computing national income, basically national income means total income earned by citizens and business of a nation, even though the citizen is living abroad. Okay, national income is the total of the payments paid for resources like land, labor, capital, and also entrepreneurship. So for the formula of calculating the national income, we must add 5 things together, which is compensation of employee, proprietors income, corporate profits, rental income, and also net interest. The sum of all that will generate national income. We go to the next one. Okay, we move on to the next one, which is making adjustment on the national income. Not every dollar spent is someone else's income, so we must add some things to the national income and also subtract others from it. So from the mind map here, I want you guys to just focus on the red one because the other items we already learned before. So for the first one is we must minus the income earned from the rest of the world with the national income, and plus income earned by the rest of the world. And then the third one is also plus with the indirect business tax, and plus with capital consumption allowance, and also plus with the statistical discrepancy. Okay, a little bit about the item income earned from the rest of the world. Basically, an earnings that our citizen in a nation get when they are working abroad. For the second one, income earned by the rest of the world, which is a foreigner working in our nation, and they will send their earning to their original nation. Indirect business tax happens when we do international business, like when export and import happens. Capital consumption allowance basically is like depreciation. That's why we must make adjustment on it, because if you don't, the number that we get is not accurate enough. The last one is statistical discrepancy, which is a mistake when accountant or any financial manager makes when calculating the numbers. Basically, that's all about the making adjustment. We go to the next one. Okay, for the last part for me is other national income accounting measurements. So basically this part have 4 different things, which is net domestic product, NDP, personal income, disposable income, and also the last one is the division of income. The first one, NDP, net domestic product, is the amount of capital consumed over a year due to the deterioration in housing, vehicles, or machinery, often referred as capital consumption allowance. The formula for this is GDP minus the capital consumption allowance. So we go to the next one, personal income. Personal income refers to the amount of income that individual actually receive. The formula is national income plus transfer payments minus the undistributed corporate profit plus social insurance taxes, and also plus corporate profit taxes. Okay. The third one is disposable income. Basically, disposable income is the portion of personal income that can be used for a consumption or saving. The formula is personal income minus the personal taxes. So for the last one is the division of income. GDP calculated as the sum of income payment to the household is sometimes called gross domestic income. The non-income items are included in gross domestic income because sales tax depreciation, and a few other items are included in the value of goods and services produced, but are not directly received by household as income. Wages include all compensation received by employees, including fringe benefits such as health insurance. Interest is net interest received by household, or the difference between the interest received on saving accounts, government bonds, and other investment, and the interest. So on the picture below, we can see that the largest components of income received by household is wages, which are more than three times as large as the profit received by the sole proprietors and the profit received by corporation combined. That's all for me. Thank you.
My name is Pan Hui. My matrix number is 300240. The production approach, also known as the value-added approach, is calculate how much value is contributed at each stage of the production. The formula of the production approach is the gross value added equal to the gross value outputs minus the value of the intermediate consumptions. This method is provide a clear picture of the contribution of different sectors to the overall economy by measuring the added value created at each stage of the production process. The advantage by using the value-added method is to avoid the double counting. By focusing on the value added at each stage of the productions, it ensures that only the value contribution by each sector to the final product is counted. It can prevent the duplication of the economy outputs. Besides that, it also reflects the structural change. It breaks down the economy into different sectors like agriculture, manufacturing, and service sector. By looking at how much value each sector adds, we can see which sectors are growing and which sectors are shrinking. For example, if the service sector is adding more value over time, this might mean that the economy are shifting towards more service industry. Besides, additionally, it's useful for analyzing sector contributions. It helps us understand which part of the economy are contributing the most to growth. By looking at each industry value added, we can see where the money is coming from. This is one of the examples to show how the value-added approach to calculating the gross domestic product. For the number one, the primary sector is growing orange juice, and the secondary sector is making orange juice and distributing juice to stock, while the tertiary sector is selling juice to the consumer. We assume that the growing orange does not include input costs. The value added is $1. When the orange is processed into orange juice, the output value is $1.5, and the value added is also $0.5. Because $1.5 minus $1, represent the additional value created in the process of turning the orange into the marketable product. When the orange juice are distributed to store, the value added is $0.75. When the orange juice are sold, the output price is $2.25, while the value added is $1.25. The sales of orange juice represent the final goods, which are consumed by the end user of our food. The total value added is taken into account and equal the value of the final goods. Consider the total output value would result in a double counting because it includes the value of the intermediate goods. By including the total output value could lead to an overestimate of the GDP. Subtracting the value of the intermediate goods from the price output can prevent the double counting. In Malaysia, our economic activities are divided into three categories, which is primary sector, secondary sector, and the service sector. For the primary sector, the example of the primary sector is the agriculture, mining, and the fishing, while the secondary sector, such as the manufacturing and the construction, and the service sector is like doctor, teachers, and others. This is the example to calculate the GDP based on the sector. The formula of the GDP is the primary sector plus the secondary sector and the tertiary sector and the tax on the import and minus the subsidiaries is equal to the GDP, which is the RM 6,500 millions. And the primary sector is the agriculture, forestry and fishing, mining and quarrying. And the secondary sector is the manufacturing and the construction sector. And the tertiary sector is the service sector. Then we minus the bank service charge and plus the import tax is equal to the GDP. The tax on imports are added as they are parts of the revenue generated within the domestic economy. while the subsidiary are abstract because they are present payments from the government to the business. They are not the parts of the market values of goods and service produced.
Now I'm going to discuss real GDP and nominal GDP. Nominal GDP is the current value of goods and services produced within an economy during a specific time. The formula is summation of current price multiplied by current quantity. For real GDP is the value of goods and services produced within an economy during a specific time adjusted for inflation or deflation. The formula is summation of base year price multiplied by current quantity. Now I'm going to discuss how to calculate GDP and real GDP. The table below shows that price of good X and quantity of good X at the first year and the second year are different. So when it comes to GDP and real GDP, at the first year they are the same, which is 1,000. But at the second year, GDP is higher than real GDP. It's because the formula of real GDP, which is base year price times current quantity. Next, I'm going to discuss difference between real GDP and nominal GDP. Real GDP expressed in base year price, but nominal GDP expressed in current year price. Real GDP values is lower, but nominal GDP values is higher. Real GDP is used for long term, but nominal GDP is used for short term. Real GDP is a good indicator for economic growth, but nominal GDP cannot be analyzed easily in economic growth. So we can calculate economic growth through this formula, which is real GDP of current price minus real GDP of previous year divided by real GDP of previous year, then multiply by 100.